Okay, welcome to this standard IAS 21 again. So after that long discussion on non net investment, just check we have done this question or not. H limited functional currency is INR. Has investment in 80% shares. Question 37. 37 it is there. Has investment in 80% share in S Limited foreign subsidiary for 12,20,000. Spot rate is 61 rupees per dollar. E Limited has given a long-term loan whose settlement is not planned. $5,000. The spot rate when the loan was given is 62. Closing rate is rupees 69 per dollar. Show SFS and CFS extract. Okay. So now you see it is a net investment in a foreign operation because it is a loan given to a subsidiary whose settlement is not planned. So it is in the nature of equity investment, but it is a monetary item. So hence we are going to apply 69 minus 62, 7 into 5,000. How much will be the exchange difference? 35,000. Treatment in SFS. In SFS, it will be shown in profit and loss statement as other income. Right. SFS of H Limited. Profit and loss statement. Profit and loss statement. Other income. Exchange difference. Gain. 5,000 into 69 minus 62. 35,000. What about SOFP? In SOFP, right, assets, non-current asset. Investment in subsidiary. Now, investment in equity share is a non-monetary item. So it will not be further retranslated. So what is the rate at which it was acquired? 12,20,000. It will remain that only. But long-term loan to subsidiary is a monetary item. 5,000 into 69. 3,45,000. Equity and liabilities. P&L account exchange difference 35,000. So this is how the net investment in foreign operation will appear in separate financial statement. Done. Now what about the SFS of S Limited? In SFS of S Limited, SOFP write down. SOFP, their functional currency is dollar. So it will appear in non-current liability as a long-term loan payable to parent 5,000. As a long-term loan payable to parent 5,000. Now write down CFS of H Limited. CFS of H Limited, consolidated statement of profit and loss. Consolidated statement of profit and loss. This time it will appear under the head OCI. Exchange difference on foreign operation. Exchange difference on foreign operation is 35,000. Next line, CBS of H Limited. Now how in CBS it will appear? First write non-current asset. Under that write investment in subsidiary. Note, this will not appear as it will be cancelled in goodwill oblique gain on bargain purchase calculation, as it will be cancelled on goodwill or gain on bargain purchase calculation. Cost of acquisition does not appear in the consolidated financial statement. That is eliminated, and what appears in place of it? Goodwill or gain on bargain purchase. Then long-term loan to subsidiary will also get cancelled. Intra-group transaction will be cancelled against long-term loan payable to parent. Nil. And in equity and liabilities, in other equity, OCI, exchange difference on foreign operation will appear 35,000. Okay. One more example. Functional currency of parent P. This is 41. Tick mark. Functional currency of parent P is Euro. Functional currency of subsidiary is USD. P has lent an amount of euro 500 to S that is not expected to be repaid in the foreseeable future. Should the exchange difference be recognized in profit and loss account? So the answer is in separate financial statement, yes. Yes or no? And in consolidated financial statement, it will be shown in OCI. So the answer is printed there. 41 number. Huh? It is different. No, I have edited it. Just you also edit. For that short term item, it is not a net investment in foreign operation. So that will be transferred to P&L account. But we are talking about this net investment in foreign operation. So this net investment in foreign operation treatment will be the amount lent by P Limited should be regarded as a permanent funding to S. In the SFS, exchange gain or loss should be recognized in P&L account. While in consolidated financial statement, it will be recognized in OCI and presented within the equity. So that was my intention. Now next question, 42. Modifying the above illustration. Suppose that for tax reasons, the permanent funding extended to S is made via another entity in the group T. So what they have done, instead of parent P funding subsidiary, another subsidiary T is used to fund this another subsidiary S. Rather than P from directly, on the direction of P, T gives loan to S. Where should the exchange difference be recognized? The answer will not change. In the consolidated financial statement, this is also like net investment in foreign operation, and therefore this will also be treated as an item of OCI. Any exchange difference in respect of the loan is recognized in OCI in the CFS because from the group's point of view, the funding relates to an investment in foreign operation. This is the case irrespective of the currency in which the loan is denominated. So if the loan is denominated in T's functional currency and assuming it is different from that of S, they have not mentioned what is the functional currency of T and S, right? It should be different. Then exchange difference will be recognized in OCI in the CFS. Now one important part for solving many questions, even for your consolidation problems, disposal of a foreign operation. Disposal would mean sale. Okay. So disposal takes place through sale, liquidation. Now in that case, what we will do, those exchange differences which have been accumulated in OCI. When did we accumulate in OCI? One, when we had converted the financial statement of foreign operation into presentation currency of the reporting entity. Is it right? So those differences which we will accumulate in OCI will be reclassified into profit and loss on disposal of foreign subsidiary. But again, there are some rules here which we will follow. This is general principle, but in some situation it is not exactly like this. Generally OCI to P&L account. So what entry we will pass? Bank account debit. Write down entry. Bank account debit. We assume full disposal. Bank account debit. In bracket write down assume full disposal. All shares you have sold. So bank account debit, proceed received. Then if it is a subsidiary and if we have any NCI balance, that also you debit. Okay. If it is NCI and we have sold the stake in subsidiary, now we will not show that NCI in the CFS. Remove NCI. Then exchange difference shown in OCI debit. That is your whatever balance is there in your OCI appearing as FCTR. Remove to net asset account, remove. And if there is a difference, to P&L account. So this P&L account may be due to two reasons. One is due to sale and one is this exchange difference transferred from OCI to P&L account being disposal of investment. Okay. This entry you will pass in the consolidation chapter also. Now partial disposal of foreign operation. Now here we have two situations. Partial disposal. What is partial disposal? We have sold some share, but not all. So we are retaining some stake in that subsidiary, associate or joint venture. So some stake sold, some stake retained. That is called partial disposal. So out of 80% share, you may sell 5% share or 80%, 70% sold. Now there can be two possibilities. Loss of control, loss of significant influence if it is a subsidiary, loss of joint control if it is a joint venture. Okay. Or no loss of control. No loss of control, no loss of significant influence, no loss of joint control. Now what do you mean by loss of control? Loss of control will be from 80%. Now you have sold 80% minus 60%. So you are having only 20% share. So you don't have control. Similarly, in significant influence, you had 30% share, so you are exercising significant influence. Now you have only 5% stake left in that company. Similarly, in joint control, you don't have joint control now. Whatever may be the change in relationship, now your joint control power has gone. No loss of control means suppose 80% share, you have moved from 80% to 70%. Significant influence from 40% to 35%. In joint control also you may have sold some stake, but still you have joint control. I am not writing percentage in case of joint control. What is important? There must be a joint control. Percentage can be anything above 0 to anything. Okay. Now what is the accounting principle here? In certain circumstances, the reporting entity may retain some interest after disposing of major portion of interest in the foreign operation. Major portion, but still have to account for as disposal of foreign operations such as loss of control in subsidiary, loss of significant influence in associate, and joint control in JCO or joint venture. Now this paragraph is quite important for solving a question. If there is a loss of control, loss of significant influence, loss of joint control, you treat it like a disposal only. Treat it like disposal. Feel sad as if I have disposed everything. To treat it like disposal. So if you want to treat it like disposal, then what will you do with that FCTR balance? You fully derecognize in P&L account. Fully transfer to P&L account. Okay. Fully, not proportionately. So there is a question below. A parent has 80% interest in subsidiary for a number of years. Subsidiary has been classified as foreign operation. $5 million have been accumulated in OCI. 80% have been accumulated in a separate component of equity. Balance 20% is attributable to NCI. Parent disposes of 40% interest, resulting in loss of control. What would be the treatment on the date of disposal? Because there is a loss of control, I will transfer the entire 4 million. How did I get 4 million? 80% of 5 million. 4 million I will recycle from OCI to P&L account. What about the NCI 1 million? That is already included in NCI. And I am going to remove NCI also, which means that 1 million already included in NCI will also get removed. Okay. So both will get transferred indirectly to profit and loss account. So $4 million of cumulative translation exchange difference will be transferred from equity to P&L account. $1 million already included in NCI are derecognized and included in the calculation of profit and loss on disposal. Is it right? One more question. P acquired 90% of subsidiary as some years ago. P now sales, I think 44, last question. P now sells its entire investment in S Limited for 1500 lakh. The net asset of S are 1000 and the NCI is 100. The cumulative exchange difference that have been arising during P's ownership are gain of 200 lakh, resulting in P's foreign currency translation reserve in respect of S having a credit balance of 180 lakh, while the cumulative amount of exchange difference that have been attributed to NCI is 20 lakh. Calculate P's gain on disposal. Calculate P's gain on disposal. So what I'll do, I will solve it by passing a journal entry on the screen. Journal entry is very easy to understand. At what amount this stake was sold? 1500. So write bank account debit 1500. What is NCI in the books? 100. and this NCI includes the share in FCTR. So NCI account debit 100. FCTR is recognized as a separate item 180. 90% of 200. Remove that. And to net asset of subsidiary. Net asset of subsidiary will also be derecognized in the CFS 1000. And to gain on disposal. Balancing figure. Is it 780? Just check. So those who want to write the journal entry can write down. Suppose they ask you pass the journal entry on derecognition. So this way you will record it. Done? Yes. This was an example of full disposal. Now we'll come to partial disposal. There is a disposal, but you will retain enough control, enough shares to retain the control or significant influence or joint control. Maybe out of 80%, 5-10% you have sold. Now in this case, again, one important thing, the treatment will vary depending upon what is that foreign operation. If that foreign operation is subsidiary, the treatment is different. And if that foreign operation is associate or joint venture, the treatment is different. Okay. So see what I have done, a small summary. It's printed in your notes also. Don't worry. Partial disposal of a foreign subsidiary, foreign operation, which does not result into loss of control or significant influence or joint control. Check whether that foreign operation is subsidiary or others. Others means associate and joint venture. If it is subsidiary, then proportionate share of exchange difference in OCI will be transferred from owner's interest to non-controlling interest, not to penal account. Right? Suppose you have 1000 in OCI, FCTR, and you have sold some stake in the company. So now what you will do, FCTR account debit to NCI, proportionate amount. So it will be just a movement from FCTR to NCI. Your, that is parent company share in FCTR will proportionately reduce, and NCI share in that FCTR will proportionately increase. That is when subsidiary stake is sold but control is still retained. But in case of JV or associate, it will be transferred to profit and loss account, even if there is no loss of control or no loss of significant influence. For JV and associate, penal account, but for subsidiary, because your stake goes down, NCI share goes up, they say that transfer it to NCI. Okay. So all these complications you have to keep in mind. Now there is a small question. Parent has 100% interest in subsidiary for a number of years. The subsidiary has been classified as a foreign operation and $5 million relating to translation difference of subsidiary has been recognized in OCI and accumulated in a separate component of equity. The parent disposes of 30% of its interest but retains control. What would be the treatment on the date of disposal? So now if you have not read it line by line the standard, some student will be tempted to answer that 30% will be transferred to penal account. Yes or no? No. Now the NCI stake will be 30% in the company. So NCI will also get 30% of this FCTR balance. So your answer will be 30% of 5, that is 1.5 million of the cumulative translation exchange difference are transferred from equity to NCI. No amount will be reclassified to profit or loss. Okay, one more question in the last part of this chapter. Question number 38. This was about subsidiary. Now what about associate? One more example. Parent P owns 35% of associate B. Now parent P sells 5% stake and retains significant influence over B. What would be the treatment of FCTR on the date of disposal? So write down the question, what would be the treatment of FCTR on the date of disposal? So what will be your answer? The question is, what would be the treatment of FCTR on the date of disposal? So your answer will be 5 by 35. That is 1 by 7 of the balance in FCTR will be reclassified to P&L account. So these two examples will help you to understand the difference. In case of partial disposal not resulting into loss of control. And the earlier two example, if there is a loss of control. Okay. Following are not disposals. And hence reclassification is not necessary. So in this kind of situation, it seems like there is a disposal, but these are not disposals. Like for example, a write down of the carrying amount of foreign operation. Only write down of the investment. You are still holding the same stake in the company. Is it a disposal? No. A write down means carrying amount gets reduced. The percentage of the stake held does not get reduced. Second example is exchange difference in respect of foreign operation classified as held for sale as per Ind AS 105 does not result in reclassification unless the foreign operation is disposed of ultimately. Now, in case of a foreign operation classified as held for sale, there is some FCTR balance. Will you transfer it to the P&L account? The answer is no. It is held for sale. It is not yet sold. And the next is again change in functional currency. Change in functional currency does not result into reclassification of exchange difference into profit and loss account unless it is disposed of. So some management, if they try to transfer FCTR to P&L account so that profit can be improved, and they might change the functional currency, not allowed. Is it right? Standard is also smart. What about income tax effect? All income tax effect, because there is an exchange difference involved, will be adjusted as per IAS 12. Will be adjusted as per IAS 12. Income tax effect. The standard says don't come to me. I am not the right standard. Go to the boss. Which standard is the boss for all income tax related adjustment? IAS 12. And now come to disclosure part. Disclosure part I have put in a summary form. The student can read the detail from the bare text. Is it right? Interested? No. Even I am not. As far as disclosure requirement for a topic like this, which is a recognition measurement type of standard, disclosure paragraphs are not very interesting. So what you have to disclose in the financial statement: amount of exchange difference recognized in profit or loss and other comprehensive income. Then in the notes to account, disclose presentation currency if different from functional currency. Had there been a change in functional currency, Reason for the same. You just can't keep changing the functional currency. You have to give convincing explanation, okay? And any supplementary financial information identified as not in compliance with IFRS, if so, adopted for its presentation. So any supplementary financial information identified as not in compliance with IFRS, if so, and currency adopted for its presentation. So if there is any deviation, this is what I understand. Now we'll discuss one important last point: difference between Ind AS 21 and IAS 21. In case of change in functional currency, when there is a change in functional currency, IAS 21 requires disclosure of the fact and the reason for the change in the functional currency. You make a small correction here. Ind AS 21 requires, first line is Ind AS 21 requires disclosure of this fact and the reason for the change in functional currency. IAS 21 requires an additional disclosure of the date of change in functional currency. Is it right? That is a difference. So most of the standard is same. This standard is over.